right, let's head to the first question. It goes to Bro. Comes from Jeff. I am 65 years old and a little less than 2 years away from my planned retirement date.
Congratulations.
Over the past 2 years, I've been investing my sizable IRA into allocations close to those recommended in the RYR model portfolios for someone in retirement, just to be conservative. Oh, they're listening to your advice.
I know. That's so great.
Your retirement.
And I'm sorry. No, I'm just kidding.
As a Fool subscriber since the early 2000s, I'm pretty comfortable with buying and holding stocks for the long haul. I am not comfortable in the world of bonds and have only bought into bonds via the bond allocation recommended in Rule Your Retirement. About 2 months ago, I sold all the bonds in the IRA to cash. I do get 1.9% on my cash in the IRA, so I'm not too anxious to get my money back into bonds. But when should I be thinking about putting all that cash back into bonds? And is it better to be in bond funds or in actual bonds?
Well, Jeff,
bonds.
So, Jeff, thanks for subscribing to Early Retirement. Of course. So
keeping food on the Brokamp family table.
Right. So the model portfolios for people in retirement is that classic split of 60% stocks, 40% bonds, although really the 40% is out of the stock market. So it can be bonds, could be cash, in particularly with what we call the income cushion, which is 3 to 5 years worth of portfolio provided income that you're supposed to get from your portfolio. That's part of that 40%, and that really should be safe, and I'm perfectly fine with that being in cash. Because, and we saw this last year, bonds do go down, particularly when interest rates go up. The Fed hiked rates 4 times last year. The prices of bonds dropped, but because of the interest, they were essentially flat for the year, so they did underperform cash. Historically, bonds outperform cash by about 2% a year. I'm cautiously optimistic that bonds will beat cash this upcoming year because the Fed is not going to raise rates 4 times. But I'm just only cautiously optimistic about that because there still could be a couple of rate hikes on the way. Plus, and we got a question about this too regarding something I had mentioned in a previous episode, and that is when you look at the bond market, it is riskier, particularly the corporate bond market. Much more of the corporate bond market now is made up of debt that is just on the verge of falling into junk territory. So the bottom line, I think, is A, I'm perfectly fine with you being in cash instead of bonds, certainly in the short term. Over the long term, I do expect bonds to outperform cash, but just by like 1 or 2%. And the riskier the makeup of your bonds, the more likely they actually will drop during the next recession. And we saw corporate bonds drop during the last Great Recession. So basically, if you want to play it safe, I'm fine with cash. If you're going to go into bonds, pay attention to the quality of the bonds. And if you're going with a bond fund, you can look at that at Morningstar, click on the portfolio tab, and it'll tell you what's in there. The other question was whether individual bonds are safer. They provide more security, but they take more work. But you can easily buy individual treasuries straight from Uncle Sam at treasurydirect.gov.